Imagine waking up in the morning, not to the sound of an alarm clock, but to the sweet sound of money flowing into your account. No more worrying about whether you're working hard enough to make ends meet. Your money is working for you. Hey everyone. Welcome back to the channel where we talk about money, investing for beginners, and wealth building strategies. So, what exactly is a dividend? Simply put, a dividend is a payment made by a company to its shareholders when you own a share of a company. You're a part owner, and just like any business owner, you get a share of the profits. When a company does well and makes a profit, it has a choice: reinvest that money into the business or share some of it with you, the shareholder. The money they pay out to shareholders is called a dividend. Dividends can be paid in cash, directly into your account, or reinvested into more shares of the company, often called a dividend reinvestment plan or DRIP, depending on the company. Dividends may be paid out quarterly, monthly, or annually. The beauty of dividends is that they provide you with passive income, money that comes in regularly without you having to sell your investments. It's like having a money tree that just keeps growing. Dividend yield. Now that you know what dividends are, let's discuss how to measure their potential returns. Dividend yield is one of the most important metrics to help you decide which stocks are right for your portfolio. What is dividend yield? Dividend yield is a percentage that shows how much income you earn from dividends relative to the price of a stock. It tells you what return you are getting based on the stock price, and it's a key factor when choosing dividend-paying stocks. The formula for dividend yield. The formula for dividend yield is simple. You take the annual dividends per share, divide it by the stock price, and multiply by 100 to get the percentage. Let's break it down with an example. Example calculation. Let's say a stock is priced at $100 and it pays an annual dividend of $10. To calculate the dividend yield, we divide $10 by $100, which gives us 0.10 or 10%. Interpreting dividend yield, a higher dividend yield means you're getting more income from your investment. However, a very high yield can also indicate more risk. For example, if a stock has a yield of 10%, that might seem great, but it's essential to look at the company's stability and ability to continue paying those dividends. Why dividend yield matters? Dividend yield matters because it helps you understand how much passive income you can expect to earn from your investments. If you're investing for income, a higher dividend yield could be your key to financial freedom. Risks of high dividend yields. But be cautious. While a high dividend yield can be enticing, it's essential to evaluate the company's financial health. A very high yield might indicate that the stock price has dropped significantly or that the company is struggling to maintain payouts. Low dividend yields. A steady approach. On the other side, a lower dividend yield might mean the company is more stable and less risky. These companies are likely to continue paying consistent dividends even during market downturns. How to use dividend yield in decision-making. When choosing between dividend-paying stocks, always consider the dividend yield alongside the company's financial health, growth potential, and risk level. It's not just about the highest yield, it's about finding the right balance. Covered call ETFs. How to earn passive income with stock options. Imagine earning money from your investments without selling a single share. Sounds great, right? That's where covered call ETFs come in. Let me show you how these unique funds can help you generate passive income with stock options. What are covered call ETFs? So, what exactly is a covered call ETF? These funds invest in stocks, just like any traditional ETF. But here's the twist. They also sell call options on those stocks. The goal? To generate extra income through the premium paid for the options. This strategy combines the best of both worlds: stock appreciation and additional income from options. How do covered call ETFs work? When an ETF sells a call option, it grants the buyer the right to purchase a stock at a specific price called the strike price by a certain date. In return, the ETF collects a premium, which is paid out as income to the investors. So you get the benefits of regular dividends and the added bonus of income from options. The benefits of covered call ETFs. You might be wondering why covered call ETFs. Well, these funds offer higher yields than traditional dividend stocks. Some popular covered call ETFs, like XYLD, OILC, and EWZ, can yield up to 12.5% or more annually. That's significantly higher than what you'd get with regular dividend-paying stocks. Plus, they're designed to provide a more stable and reliable income stream. Risks of covered call at Shauver. Like any investment strategy, covered call ETFs have their own risks. If the stock price rises above the strike price, the ETF may be forced to sell the stock, potentially missing out on further gains. Also, options can expire worthless if the stock price doesn't hit the strike price, meaning the premium collected could be lower than expected. So it's important to understand these risks when considering this strategy. Example, let's say you want to earn $2,500 per month or $30,000 per year through covered call ETFs. With a yield of about 12%, you'd need an investment ranging from $225,000 to $250,000. Depending on the ETF, this is far less than the $1.8 million you would need with traditional dividend stocks. Covered call ETFs allow you to reach your financial goals faster without needing to make an enormous investment. With a more efficient use of capital, you can earn regular income while still maintaining your investments. It's a powerful tool in your financial toolbox for building passive income streams. Covered call ETFs offer a smart, efficient way to earn passive income. If you're looking for a way to grow your wealth without having to sell your investments, this could be the strategy for you. To learn more about covered call ETFs and how they can work for you, check out the resources linked below and be sure to subscribe for more investment tips. Next, high-yield REITs. Severe thought about earning income from real estate without actually buying property. That's where high-yield REITs come in. Let me explain how investing in these funds can help you generate passive income through real estate investments. REITs, or real estate investment trusts, are companies that invest in a variety of real estate properties like malls, office buildings, apartments, and more. As a REIT investor, you get to own a portion of the real estate and earn income from rents and property sales without the need to manage the properties yourself. How do REITs work? REITs work by collecting rent from tenants and other sources of income, like property sales. They then distribute a large portion of that income to investors as dividends. It's like owning a piece of real estate, but without the hassle of property management. Some REITs stand out for their high yields. For example, Two Harbors offers a yield of 20.3%, Brandywine Realty Trust gives you 19.9%, and Orchid Island Capital offers 19.4%. These REITs offer attractive dividends, which can be a great way to boost your passive income stream potential. Risks of high-yield REITs. However, with high yields come some risks. For instance, REITs depend on tenant occupancy rates and the economy. If fewer tenants are paying rent, or the economy takes a downturn, the dividends you receive might decrease. So it's important to choose your REITs wisely and stay informed about market conditions. Example, let's say your goal is to earn $2,500 a month or $30,000 per year from REITs. If you're investing in REITs with a yield of around 10.8%, you would need to invest $320,000. However, with a higher yielding REIT like Two Harbors offering 20.3%, you'd only need to invest around $148,000 to reach the same annual income goal. Getting started with REITs is relatively simple. You can start by researching high-yield REITs and selecting those that match your risk tolerance and income goals. Look for REITs that pay monthly dividends, as this will provide you with a consistent income stream. High-yield REITs can be a great way to generate passive income effortlessly. To learn more about investing in REITs and other income-generating strategies, remember to subscribe not to miss out other videos. Dividend Aristocrats are reliable stocks that pay you dividends year after year. What are Dividend Aristocrats? Dividend Aristocrats are companies in the S&P 500 index that have consistently raised their dividends for at least 25 consecutive years. This elite group is recognized for their stability and commitment to rewarding shareholders, making them an attractive option for investors seeking reliable income streams. What makes Dividend Aristocrats stand out is their commitment to increasing dividends even during economic downturns. These companies have strong balance sheets, steady cash flow, and a solid business model that allows them to keep paying and growing their dividends. One of the main benefits of investing in Dividend Aristocrats is the consistent income they provide. Over time, your dividend income grows, giving you more financial security and an ever-growing passive income stream. This makes Dividend Aristocrats a powerful tool for long-term investors. Let's take a look at a few examples. Companies like 3M, Coca-Cola, and Johnson & Johnson are part of the Dividend Aristocrats group. These companies offer reliable dividend yields such as 6.2%, 5.6%, and 5.8%, respectively. These high yields make them attractive choices for income-focused investors. Before we continue, I have a free investing guide just for you. I've created a free guide called Top 5 High-Interest Investments for Maximum Compounding. Inside, you'll learn the best investment strategies used by top investors to multiply their money faster. Click the link in the description to download it now. Let's proceed. To earn a steady stream of passive income from Dividend Aristocrats, you need to calculate how much you should invest. For example, if you're aiming to make $30,000 per year at a 6% dividend yield, you would need to invest around $500,000. The more you invest, the more passive income you can generate over time. Dividend Aristocrats are a fantastic choice for anyone seeking consistent, reliable passive income. Their long track record of increasing dividends, coupled with their strong financial stability, makes them perfect for long-term investors who want to build wealth and achieve financial independence. Hit the subscribe button to stay up to date on all our investing tips. And don't forget to check out other videos on building passive income with stocks and ETFs. Finally, the beauty of modern finance is the ability to personalize your strategy to suit your goals. Whether you're looking for more control or flexibility, there's an approach that's right for you. Every investor has unique goals, timelines, and risk tolerance. Some may want to retire early, while others are building long-term wealth. Personalizing your strategy means aligning your investments with these individual needs, setting you on the right path. Flexibility is key. Life happens: bonuses, job changes, or unexpected expenses. With a flexible investment strategy, you can adjust your portfolio quickly, ensuring you stay on track despite changes in your personal or financial life. Personalization isn't just about the goals, it's also about balancing risk. Whether you prefer conservative investment or are ready to take on higher risk for potential rewards, customizing your portfolio lets you choose the right amount of risk for your comfort. Short-term and long-term goals require different strategies. Personalizing your investments for both can help you hit milestones like saving for a vacation now, while also planning for that dream home. Automation makes personalized investing easier. With robo-advisors and automatic contributions, you can stay on track with minimal effort, ensuring your strategy remains intact without constant manual input. Real-life example: take John. For example, he's looking to retire early with passive income by investing in dividend stocks, REITs, and ETFs. He personalizes his strategy. He can also adapt quickly to changes in his life, making it a flexible approach to achieving his financial freedom. Personalization and flexibility give you the control to design your financial future. By customizing your strategy, you align your investments with your goals and comfort, setting you up for long-term success. If you're ready to start personalizing your investment strategy, don't forget to like, subscribe, and click the bell. For more tips, comment below with your financial goals. We'd love to hear about your journey.